Hi, and welcome to today's Learning Series webinar. We are delighted to cover a topic today that I think can save a lot of people money in taxes if they understood the concept of cost segregation. So we're more than delighted to have a tax group with us today to cover that. Because of the topic, one of the things we'd like is open up to take questions as we go. So on your go-to control panel, please locate the questions tab. And if you click that questions tab, you'll have the opportunity to type your questions in, send them in, and I'll be watching and monitoring those and letting Kelly know about questions that we have as we go. So please send us those as you have questions. We'll have some time for Q&A at the end of the webinar. And then when the webinar concludes, it would be great if you could stay online for just a quick second. We have a few survey questions and it would be awesome to get feedback from everybody. So what I'd like to do is talk today about our guest. Our guest is Kelly Colvin. Kelly is from National Tax Group, and I'll let him introduce himself. Things away. Kelly, it's all yours.
Thank you, Ralph. Again, appreciate you having me and allowing me to talk to the members and kind of give them some updates on some best practices to use for their real estate. Obviously, as hoteliers, your most expensive asset is your hotel. And so we want to be able to teach some tools to use so that you can take advantage of the capital that's locked into them so that you can pay less taxes. That's really the whole point. But as you'd said, my name is Kelly Colvin. I'm Vice President of National Tax Group. A little bit of background on myself. I worked in corporate tax with PricewaterhouseCoopers in tax compliance, and I just kind of realized that I had a higher calling of being able to create relationships and work in this area where I could really help focus on specific tax issues, one being cost segregation. So I've been working for the firm for a little bit over 2 years now, and love every second of it. I'm very involved in the AHOA area. So actually, if any of you are hailing from the Southeast Texas region, I'm going to be at the AHOA Regional Conference at the end of this as well. So today I'll be at that regional trade show. So if you have any questions, you want to stop by in person, I'll be there as well. So I always love starting with this quote. It just gets me every time. The difference between death and taxes is death doesn't get worse every time Congress meets. It's funny, sometimes it hurts as well, because obviously, you know, when a tax law changes, it can definitely hurt your bottom line as a business owner. So one thing we try to do often is, again, help focus and give our clients the proper tools to help reduce those tax liabilities so that you can focus on other things and utilize that cash in the appropriate areas of your business. So again, as we've mentioned, the two topics I'll be speaking on are cost segregation and the 179D deduction. Both are related to accelerated depreciation, and 179D is a lesser known tool for tax depreciation, but it's all in regards to energy efficiency in your buildings, which as hoteliers, you know, one of the biggest things is always trying to make sure your building is operating efficiently to lower your bills and lower your energy consumption. So we'll go a little bit more into that a little bit later. So again, what is cost segregation? As I've said it on my intro, it is an IRS best practice. Not a lot of owners realize that when not taking advantage of cost segregation, you're actually outside of what they would prefer you to do. So this is your ability to take and depreciate your building at a more efficient and streamlined method. So you'd be taking higher expenses up front in the early stages of your business. The engineering method is the process that we specialize in. So although our name is National Tax Group, we're actually an engineering firm. We have 2 licensed engineers and a team that sit underneath them that specialize in 2 areas of depreciation and energy efficiency. So working and using those tools, we allow our clients to take these great tax deductions. So realistically, cost segregation, when you buy an asset or you buy a new hotel, those costs are incurred and they're lumped up into one number. They're all in one lump sum of the building. And if you're depreciating that value, you're you're not really taking advantage of the most taxable expense that you can. So what cost segregation does is an engineer, a cost seg engineer will come in and they will break apart that building into their appropriate banks, the 5, 7, and 15-year asset classes. So if you leave a number in the building, so when you purchase it, you've got your sale price, or if you build it as well, your building construction price is lumped into one number, but those need to be broken down so that you can expense those values at their appropriate life. So your FF&E packages, your flooring, the walls, different aspects of the property outside, so your property improvements, parking lot, curbstones, those things are all depreciated at a lesser value or at a lower lifespan so that you can, again, expense higher numbers quicker. That will then offset some of your costs and your taxable income up front, which frees cash flow up. So realistically, is the larger expenses up front when you're in your initial business stage will allow you to kind of help direct those funds and either reinvest them or, again, save them and put them away into areas that are more important to you up front. So this is a good breakdown of what a cost segregation would look like. It's a pretty good visual depiction. We're able to take your building at 100% and break it out anywhere in the 25 to 30% range. So we're able to reallocate values of a property. And if you see these breakdowns here, so our 15-year property, we're usually able to capture about 6% of purchase or build price coming from the building. The 7-year property, that is one of the lesser known areas for value. So we generally can get in that probably 1% to 2.5%. And then the 5-year property, which is actually, this is your most valuable portion of the cost segregation. This is going to be the biggest chunk we're able to pull out, and it's going to allow you to expense up to 25% of your building, and it'll break it up into a 5-year depreciable life. That again will front load a heavy amount of expenses to again offset that taxable income that you're bringing in those initial business years. So for timing on cost segregation, it's important to note that there are good times and there are bad times to do a cost segregation. There's a sweet spot within the first 5 years of purchase or build of your hotel. And the reason for that is based on that slide, the 5-year assets that we identify for depreciation purposes are the largest chunk of what we are able to pull out of your cost segregation report. So acting within the first 5 years of owning your asset is where you're going to get the highest value pulled out, and which again will then allow you to take those larger expense numbers on your tax return. So as far as eligibility, I do have many AHOA members that I work with that are in more than just hotel spaces. They also own commercial, industrial properties. They own multifamilies. They also own just single-family rental properties. Cost segregation is available to you on anything that you're able to depreciate for business purposes. So again, it could be a single family home that you have as a rental income property. It can be a garage, a office space, anything again that's real estate that is able to be expensed for business purposes. We can do a cost segregation for you. And again, I highly recommend it just as the fact that it is the best practice. The IRS expects that you should be doing this on your tax return. So this is a quick breakdown. It's a kind of very easy example of cost segregation. So you look at the total value of a $2 million asset, and at the 30% cost segregation range, that $600,000 is what we would pull out from cost segregation. So I guess to kind of explain that a little bit better is, that $2 million, if you're expensing it on your tax return, which is depreciation, it's going to be broken out at 39 years. So you're going to get a 39th of that value every year for that 39-year lifespan of your property. That 600,000 is a chunk that, again, we'll be pulling out, so that we'll be allocating it to your 5-year assets, your 7 and your 15. Again, it's going to increase your ability to expense the building up front. So do we have any questions, or is there anybody that may have something that they'd like to ask at this point? I feel like I've kind of gone for a little bit.
I'm monitoring the questions. Here we go. All right, so I've got one just came in. How does bonus depreciation affect this?
So that's a very good question. Bonus depreciation is an owner's ability to expense at a higher percentage the amount of 5, 7, and 15-year assets. So what we will do as a cost segregation firm is we will identify all of, again, the 5, 7, and 15-year assets. IRS regulations allows for bonus depreciation purposes you to expense at this time for the tax year of 2023, you're able to expense 80% of everything identified in those values. So what you'd be able to do, so of that 600,000, you could expense 80% of that value on your 2023 tax return. However, I always preface the fact that that's a conversation that I urge you to have with your CPA. Everything that we do, we also do hand in hand with our client CPA, because our client CPA have your entire tax picture and they know that whole picture. So we always make sure that when we're doing these projects, the client CPA is well informed with what we're doing, because the information we provide through our cost segregation is then able to be taken by your CPA, which can take the bonus depreciation values as needed. So they could bonus the 5-year assets or the 7 or the 15, depending on what your needs are for your entire tax picture. But yes, the work that we do identifies what's eligible for bonus depreciation.
I have another one. Among the different real estate types, how do hotels rank in terms of being able to do this the most? I would think that other kinds of assets like warehouses would be less than others.
So when it comes to the hotel space, one of the reasons why we are heavily involved with AHOA is because the success rate that we have on our cost segregations for hotels. As you all may know, you have heavy amount of internal assets in that building, your FF&E packages, your equipment, everything's broken in. And when you buy a hotel, all that equipment needs to be identified and pulled out. So with hotels, we actually have a very high success rate. We're more in the higher 22.5% to 25% for 5-year asset classes. Again, each hotel is different. So I am talking more in generality, but hotels are a very successful asset class to be able to use cost segregation. So here's another quick example of accelerated depreciation for a hotel. So this is a new construction, $18.8 million property. And for this purpose, we were able to reallocate 20.1%. And so this shows your different breakdowns of first year depreciation. So as I've said before, for our work, we won't identify and guarantee your bonus depreciation numbers. We want you to understand that the bonus depreciation, again, is a conversation for you and your CPA. But just by doing a straight to form cost segregation on an asset, you're still increasing your expenses. So for this building, the first year additional depreciation is going to be $1.5 million in expenses. And the after-tax savings, if you look to the right there, is $622,000. So that's an actual cash savings of $622,000 just by executing on a cost segregation plan for their property. And then the entire 5-year additional depreciation is that 2.8, which again, with the after tax is 1.1 million in savings. So you can see that, again, everything's dependent on the size, style, and scale of your hotel. but realistically is anything, you know, over $1 million, you have a high likelihood to take advantage of those numbers. And even the smaller assets still have benefit, but just know that because we're working in percentages and size and scale of a property, you know, obviously the higher value of a hotel, the larger the numbers will be. But even if it is a less expensive asset, you're still going to be able to take advantage of some great numbers and expenses on your tax return. So as part of our process, one of the best practices for cost segregation, we always recommend a site inspection. So I'm going to go into that and why we do that. But you would engage a firm like us. Our engineer is going to establish your current taxable basis on the property. So this can be utilizing your closing statements or your final payout to contractors if it's a new construction build, but we'll establish your taxable basis on the property. We'll conduct a site visit of the asset. And the reason this is important, so I want to kind of spin this in order for us to help you, we always back our work up, and this is an important task item to note, is part of what we do is we will support our clients in our work afterwards. So everything that goes to the IRS is always subject to review, everything, every time you prepare a tax return. So our firm will provide full audit support in the case it was ever looked at by an IRS examiner. But in order to do that and provide a good paper trail with good practices and processes behind it, we always conduct a site inspection of our clients' properties. This allows us to report on and attest and really get in the details that we need so that we're capturing and really creating a good cost segregation report for you. So once we've conducted that site inspection, our engineer is going to prepare a detailed depreciation schedule for that property. He's going to break down all the fine details of depreciation and those asset items for your building. We draft a report for you, and with that draft, we're going to submit it to you for review with yourself and your CPA. Because again, this is a team effort. We always want to work with our client to make sure that everything that we're reporting on is fair and true to the building, because nobody knows a property better than the owner. So we're always going to ask your opinion and check our numbers and check our work to make sure that it really does depict and fits that asset. Obviously, our engineering professionals know what they're doing, and it's not going to probably change too much, but we always want to make sure that we're having an open dialogue with our client while we're preparing the work. Once those reports are reviewed and revised, depending on the need, we'll deliver our final report to yourself and your CPA. And then the report that we provide to you goes directly on your tax return. This is going to be the detailed depreciation report that your CPA will rely on moving forward with your business. So starting in the year that we provide the report and moving forward on all tax returns to follow that.
Ellie, I have a question that just come in. If you were to do a cost segregation, does that get me audited, or does it increase the chance that, or does it increase the chance of getting audited? I never used and have not been auditing, doing what I used to. It looks like the question, the gist of the question is there a chance of increasing your likelihood of being audited? Can you speak to that?
Yes, and the answer is no. So as I've said before, cost segregation is the approved and best practice accepted by the IRS. So when a client is, say they're changing, they didn't have a cost seg in their first year or two of the business, and they're changing their accounting methods over to cost segregation on a tax return, they're actually changing from an unapproved depreciation schedule to an accepted approved depreciation schedule. So you're actually conforming with the IRS's wants. So when you're doing that, you're not causing any type of red flag for audit on the property. So you're actually getting into in line with what their needs and their acceptable tax or accounting methods are. So no, it does not increase your risk of audit. business owners that are in the trade of owning real estate utilize cost segregation on a daily basis. So it is not a red flag to the IRS. They actually expect and want you to do it. So it's not a problem. And again, from our standpoint, even if it was ever identified under audit, you would just call us and we would come and we would defend our work. And again, we use all the IRS best practices and acceptable methods, so nothing to worry about.
Okay, here's another one, and that is it relates to timing. So the average turnaround time for a cost segregation study, and it relates to 2023. If you have it done this year, does it have to be used in the 2023 tax year?
So it would be the best method to be utilized in 2023. So if say, you know, an owner were to buy something right now or build something in 2023 and this is year one, it's always best to start with the acceptable method. So the one thing, just from an IRS standpoint, they look for consistency. So if you're starting off in year one, your first tax return, if this is the first year that you're speaking, that the business is filing a return, you're starting off in the correct method. So you're being consistent starting from year one. So excuse me. I would highly recommend that if you're going to pay the money to have a cost seg performed, that you should be utilizing it in the immediate tax year. So now I'm going to touch on another portion of accelerated depreciation. It's called the 179D energy efficiency deduction. Kind of a mouthful, but it is a tax tool that is so underutilized, and I can kind of explain why. It's all based on energy efficiency in commercial real estate. So hotel owners are always, as you're all going to know, you're always chasing the opportunity to save money on your electric bill, on your gas consumption, on your water bills. And part of that is by creating more efficiencies in the building. So upgrading your HVAC units, upgrading the electrical in the property, you know, converting to LED, or if you're starting a brand new construction property, you're going to want to put in and implement the best tools inside the building to make sure that when you're starting on day one, you are the most efficient you can be. 179D is a per square foot tax deduction. And again, it's based off of energy efficiency. In order to take advantage of it, you are required to have an engineer perform a model, an energy model on the property. So that's where we come into play. We can just move on to the next slide real quick.
Kelly, I'm gonna pause you there. This, I think, is a related question, and it is it comes down. It is if you purchase a hotel and your group or any group is hired to perform the study, who provides the cost to each detailed item? Or is the owner providing that, or is your company providing that?
So on a cost segregation report, we are going to collect all the pertinent data of a building. And so we'll take, again, your closing statements, all of your costs and incurred costs into the building, or again, if it's a new construction, we would be gathering your construction report, final cost of the construction project, and all that stuff. And their cost segregation engineers use a federal standard called RS means. So we would break that all up. Based on the area the hotel is in, we look at going construction rates on the cost of land improvements, your curbstones, your light stances, all that stuff. So we would break that down and we would provide those cost details as part of our report. So we wouldn't expect all of that data to be provided. We're going to capture everything we can from you, but when we do our breakout, it's going to be based on best cost segregation standards based on the industry.
Okay.
So for 179D, this is a tax deduction that was established in 2006. And again, it's meant to incentivize energy efficiency, new construction and upgrades in a commercial building. It's something that hotel owners do every day. The types of improvements I'd mentioned before, if you're upgrading your HVAC system, your hot water systems, your lighting in the property, these are things that are done on a regular basis. Even if you're just doing a PIP, sometimes it's things that you have to do. So if a hotel that you own currently, that you personally improved or built yourself anytime after 2006, you're eligible for this tax deduction. And it ranges in a portion of up to 60 cents a square foot, all the way to up to $5 a square foot. Those values are based off of when the building was upgraded, when you placed it in service. But again, it's per square foot on the building, and that value really adds up depending on the size and scale of your upgrades and the size and scale of the building itself. So for this deduction, what qualifies, again, as I've mentioned before, is any upgrades to your HVAC and hot water systems, but it does have to be an entire overhaul of the system. It can't just be one air handler or one hot water heater. It does have to be a substantial improvement to the building. So all of your PTAC units, most of your water heaters, depending on how your property is built, if you have 4 key boilers, it's going to have to be a substantial upgrade to the boilers, as well as your HVAC and air handlers. And obviously too, is for if it's a lighting portion, it's going to have to be all of your lighting to the interior of the building. Everything under roof needs to be improved in order to do these upgrades. If it's new construction, it's everything, because it's brand new and you've paid for those updates to a brand new building. That would also allow you to be qualified for that as well. So this is a quick example of a Hampton Inn. So this building was 66,000 square foot, and just to show the true deduction values, it is an entire per square foot value for this building in particular, based on when it was placed in service. This was a full $1.80 a square foot on the building, and again, that was $119,000 deduction on top of any other type of depreciation you may have taken through cost segregation or any of these any other type of depreciation expenses on the asset. This is on top of it. It's not one or the other situation. You can take this as well in line with any type of accelerated depreciation you take as well.
Kelly, I have a question. I changed my lights to LED and PTAC. I changed my lights to LED and my PTACs. Is that enough to qualify?
As long as it was an entire improvement to the building, so all of the PTAC units, all of the lighting, the answer would be it would qualify. I would have to. There's always a but situation, so I would want to take a look at the whole property to see because some of the limitations of this deduction it's based on square footage. So if you do have a smaller boutique hotel or an exterior corridor that may be anywhere under 30,000 square feet, because the deduction is based on square footage, we always have to look at the return on investment for the client. So there's obviously a fee structure to the system. We have to do a certification to allow you to take that deduction, and we would have to make sure that the value is there for you. We as a company, at least on the National Tax Group side, don't like taking on projects where the client isn't going to benefit the most from our services. So a PTAC and an LED upgrade would qualify you. And so long as the building was, upwards of 30,000 square feet plus, this deduction would be valuable to you. So again, the little takeaways here is I want members to understand that the most valuable tool you have is your building. It's the most expensive thing you're ever going to pay for, and the IRS has tools in place where they want you to be able to take advantage of expensing it and really helping yourself save on some cash flow. Like, they put these tools in place for your use, And as hoteliers, you have value at your fingertips that you should be taking advantage of. Lowering up your tax liability on these properties, again, will free you up for other investments. I know a good chunk of my clients are constantly looking for other partnerships to have with their friends, their family, to buy the next family so that they can buy their next hotel or their next commercial space, or just the next wealth building investment they need. This is the opportunity to do that by lowering tax liability, because obviously if your hotel is generating revenue, you want to be able to offset that so that you can really take that cash and use it as you please versus paying the government. Again, the goal is to always pay less tax in the most legal way possible, and this is a great way to do it. So I really, really urge you all to keep staying educated on these things. This is your business, so always keep your mind open. Your CPA is one of your best partners to have. They are educated, they're good at what they do, but they're not perfect, and they don't always have every answer. So I really urge you to again, keep your ears open, pay attention to the tools that are available to you, and continue to grow your businesses. And if you need to get a hold of me, that's my email, and the number on the bottom, that is my direct office line. So if anyone has any follow-up questions they'd like to shoot over to me, please reach out. I want to hear from you. If I don't get back to you right off the bat, if you do have something maybe this week, just know that I'm traveling and I'll be back in the office on Thursday afternoon. So would be happy to answer your questions, jump on a phone call. Or again, if you're in the Southeast Texas area, I can see you in about an hour at the regional conference.
Kelly, this is great information. I don't see the question here, but generally, one question that occurs to me is, how do cost segregation firms typically get compensated? How does that work?
So from our standpoint, we do a flat fee basis. So I would take a look at your property, and it would be a fee set based on the amount of engineering work involved. So not one property is alike. So again, larger properties require larger accounting and engineering work to break down those costs for you. So we would establish an upfront, not an upfront fee, but sorry, we would establish a fee before we get engaged. And then our firm, we do not collect our fees until we fully provided our services. So we'll invoice our clients upon delivery of a complete project.
Okay. All right. Well, great information. I hope that this, I'm certain this webinar contains information that's going to help a lot of folks. We really appreciate your time today, Kelly. Appreciate your group. Thanks for supporting our members. And members on the call, thanks so much for joining us today. And we look forward to seeing you soon at another AAHOA Learning Series webinar. Have a great day.
Thank you, everybody. Thank you again, Ralph. This was great.